Greetings, and welcome back to the Rose Bros podcast. This episode, we are joined by Mr. Craig Bryska, President and Chief Executive Officer of Crescent Point Energy, a New York Stock Exchange and TSX-listed company with a market cap of approximately $6 billion on both exchanges. Prior to becoming CEO, Mr. Bryksa was Vice President Engineering West and has held a number of senior management roles within Crescent Point since joining the company in 2006, directly overseeing the development and operations of each of Crescent Point's core assets. Mr. Bryksa's experience as a professional engineer in the oil and gas industry also includes working with companies such as Enerplus and McDaniel and Associates. Mr. Bryksa is a member of the Association of Professional Engineers and Geoscientists of Alberta and the Association of Professional Engineers and Geoscientists of Saskatchewan. He also holds a Bachelor of Applied Science degree in Petroleum Engineering from the University of Regina. Among other things, we sat down and discussed top well results, returning 60% of capital to shareholders, and rebuilding a better company. Enjoy. This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This episode is brought to you by Canada Action, whose aim is to promote the importance of Canada's energy industry, which is the bedrock of our nation's economy, providing hundreds of thousands of jobs and economic opportunities across the country. Learn more at canadaaction.ca or check out Canada Action on social media. This podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny Osborne Parody, headracingcanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info and get your high-performance ski gear for the upcoming season. Okay, well, why don't we begin?
Sure.
Craig, good morning. Thank you very much for doing this.
Yeah, well, thanks for having me.
I really appreciate it. I know your time is valuable. So
Yeah, no, there's always time for things like this for sure.
like we were saying, there seems to be a direct correlation with some of the busiest people, successful people, and how easy it is and their willingness to do things like this. So it's kind of a paradox.
Well, thanks for that. I think especially when you look across our industry, it's full of great people, and a great number of teams running great companies. And one of the things that I've come to know too, just like you mentioned, is they always have time, and they always have time for you as an individual. So I'm more than happy to sit here and chat.
There are no scripted questions here. In this scenario, you just sat down and talked. So
yeah, that sounds good.
Maybe just for the listener, to start from the top, you're the CEO of Crescent Point, but to get it from the source, what is Crescent Point?
Yeah, so I've been the CEO, lucky enough to have been the CEO with Crescent Point now for just over 5 years. I'll tell you, Crescent Point is from a high level is an energy company. So we produce oil and gas. And I think we do a very, very good job of it. And I think we've done a lot of changes over the last 5 years that have made us even a better company. But, honestly, at the end of the day, Crescent Point is a collection of great people. Whether you look at it from the board to the executive team to the staff that really run the business, it is a collection of great people doing great things. And I am just happy to be part of it.
How'd you get into energy?
It's funny. I look back on that too. So I graduated university in 2002 and I've been working in energy since then. And I actually had some summer jobs along the way in the energy sector. But as I was sitting, thinking what to do with my life after high school, I went to work for a car dealership for a few years as a parts guy, like parts person and I quickly realized that, $10 an hour probably isn't enough to have the type of life I would have liked to have had. And through that, I started thinking of what I was going to do. And I actually had a friend of mine who was on his own journey and he ended up enrolling at SAIT, taking that petroleum systems engineering technology at that point in time. And he ended up pulling me that way with him. And I joined the year later. So I ended up going to SAIT and then I transferred after SAIT. So I graduated from SAIT with a petroleum tech diploma. And then I ended up transferring into the University of Regina And then I graduated from the University of Regina in petroleum systems engineering in 2002. And since then, it's been a collection of great companies, having a lot of fun. Obviously, a very challenging sector, but can be a very rewarding sector from all levels as well. So I'm just happy to be part of it. I'm so proud of Canadian energy and what we do for this country.
Today, given that you're the CEO of Crescent Point, we might structure the conversation around the perspective of an investor.
Sure.
Interested in Crescent Point. So to get into it a little bit, in the old days, the captain of the ship, so to speak, got to keep most of the gold. But on the flip side, if the ship went down, he went down with the ship. From that perspective, how do you align yourself with the shareholders of Crescent Point to create a symmetry of risk?
Yeah, I think if you look at the portfolio we've built out, if you look at our capital allocation framework, and more importantly, if you look at our return to capital allocation framework that we have, that's a very transparent view on how Crescent Point is going to return capital to our shareholders. I think that structure is in place that's really built that out, in order to allow us to deliver that. So just as an example, Crescent Point returns 50% of its discretionary funds flow to our shareholders in the form of return to capital. And that's over and above our base level dividend. So if you take our base dividend, you take our return framework, we actually return 60% of our excess cash flow to our shareholders. So really the tool of choice on top of the base level dividend has been share repurchases in the background is how we've been executing against that. And just as an example, this year, we'll be somewhere in the neighborhood of $1.1-ish billion of excess cash flow, of which 60% is going back to our shareholders. And having those frameworks in place, both the capital allocation and the return framework, is basically a social contract with the market on, hey, this is what we are going to deliver to you, and we're going to deliver it to you on a quarterly basis, and you can, expect us to continue that going forward. So having those in place is very, very comforting to me. The other thing I would say is when you look at, to your point on the captains of the ship in the old days, maybe we're able to keep a big percentage of the bounty. Now, when you look at our executive comp structure, in particular my comp structure, a big component of that is risk, and it's risk on a short-term incentive plan, so a bonus, and that is very largely tied to corporate performance over the year, and at the same time to a number of ESG metrics. And then when you look at our long-term incentive, again, tied mainly to corporate performance and how the company performs, but also, again, the ESG measures in there as well, particularly around the environment and the sustainability of the company. So the comp structure is aligned with corporate performance, which is ultimately aligned with our shareholders. And then our return to capital framework is ultimately aligned with returning a significant amount of our excess cash flow directly to our shareholders in the form of base dividends and then share repurchases. So that's how we think through things here, but certainly it's changed, I guess, over the years.
Lots of engineers start out in the industry in the beginning, thousands, depending how you look at it, but not many make it to the top. From your perspective, what do you think has led to where you are today? Is it technical excellence, or is it a deep knowledge in that area? Or what do you think has led you down this path?
Yeah, so I'm lucky enough to have had the opportunity to step into this role. For me, this journey really started post-graduation, 2002, like I mentioned, but even some energy work prior to that. And I think, a lot of it is just, this is going to sound old-fashioned, but a lot of it is hard work. It's just putting your nose down and grinding things out and continuing to work hard and just showing who you are as a person along the way. And ultimately, you want to be a good person and a good team player. And I think that speaks for itself as people recognize that. The other thing I would tell you is you don't know what opportunity is going to be put in front of you. And you don't know the time of that. And you may think in your mind, well, I'm not ready for that, or I want to do this first. And you know what I've come to terms with along the way is you just say yes. If that opportunity is in front of you, have the comfort and the confidence in yourself that, truly knows that you can do it and you can do it. And you just say yes. Because when you say yes, you don't know what the next step is coming behind that and where this leads. And honestly, I look back at my career and there's a number of things that I've thought, what would have happened if I didn't say yes? Where would I have been? So for me, lucky that each of those steps along the way where I said yes allowed me to progress into where I am today. The other thing I would tell you too is if you look back on your career, and I do this often, I'm sure you do, there's points along that journey where you realize how painful those things maybe were. But ultimately, I tend to think of that as a bit of a blessing, like something that's that hard and you need to really grind through it and work through it. At the end of the day, it makes you better in some way, shape, or form. And whether that's personal or professional, for me, I can look back on the journey, and the journey's still going on, but certainly there's some things in there that I'm like, wow, that is so painful that this cannot possibly not be good for me. So at the end of the day, I guess I would say just say yes, because you never know. And it's easy to say, but I guess
here we are.
Yeah. Yeah.
The concept of resilience. Crescent Point has had its ups and downs, turbulence, so to speak, but here we are. Crescent Point is still here, growing company that's doing really well. From your perspective, how and why has Crescent Point been so resilient? Is it the assets, management?
Yeah, I think so. Let's step back 5 years where we put a new team in place here. The board put a new team in place to really take the company and make some changes and evolve it to go forward. And I'm extremely proud of what the management team, the board, and the staff in the company have been able to accomplish in really 5 years, which isn't a very long time, especially when you think we basically lost 2 of those years to COVID. And so that really stunted things here and then over that time period, but very happy with where we are. If you think of, we started out 5 years ago, we had about $4.4 billion of debt. We're going to exit this year somewhere around $2 billion-ish of absolute debt, sub 1 times debt to cash flow. During that journey, we've completely rebuilt our portfolio. So, we had been known in the past for mainly a Saskatchewan producer, an oily producer, mainly Saskatchewan assets. As we went through it with the management team early on and really started to dig into the details of the portfolio, we recognized fairly early in there that we need to make some changes if we wanted to really advance the long-term strategy that we had. And that's really to have a long-term sustainable company that is ultimately very competitive on a growth profile and at the same time on a returns profile. And now I can paint you a picture where on the combination of adding the Duvernay asset first and now bringing in the Montney and pairing that with our Saskatchewan assets, how that portfolio has shaped together has really maybe opened some eyes in this organization on the sustainability and what we look like going forward. So, if a company has an overarching corporate strategy like we do, we also have underneath that, you have different layers of, call them sub-strategies underneath. And one of those for us is our portfolio strategy. So we think of pairing short cycle assets with long cycle assets. And ultimately that we believe that builds you a resilient portfolio that allows you to weather the ups and downs. So short cycle, I would describe as our Duvernay and our Alberta Montney position. These are horizontal multi-stage fracs, generally have very high IPs, have quick payouts, or high rate of returns. They allow us to get the cash back in the system and reinvest fairly quickly. We think of pairing those type of assets with our longer cycle assets. And long cycle assets for Crescent Point are our water floods and polymer floods in Saskatchewan. So a little bit more lumpy capital and production profile, but at the same time generally have a lower decline rate. So when you pair that with, like I say, the short cycle, it really balances yin and yang. So for us, as we built that portfolio out here over the last 5 years, extremely happy with where we are today. The other thing I'd tell you, and these are just stats that as you sit down and you think back through things. If we're 150,000 barrels of production today, post our North Dakota disposition, 95,000 BOE per day was not in this company in March of 2021. 70% of the capital that we're allocating within the assets across the portfolio wasn't in this company in March of 2021. So I would argue it's been completely rebuilt, maybe under people's noses in the last 5 years. And again, 2 of those years we had to deal with COVID. Along that journey, so you have all this going on in the background. Along that journey, we paid off $5 billion worth of debt directed towards the balance sheet. We've returned to date about $1.5 billion of excess cash flow in return of capital to our shareholders, and that's going to continue to grow. And now, when you look at our portfolio our 5-year plan takes us from where we are today at 148,000 BOE per day to 180,000 BOE per day over the next 5 years. That's 5% CAGR on production. It's 3% CAGR growth on our excess cash flow per share. So again, that's going to grow your return of capital along the way. But the beautiful thing about it is not only do we have that 5-year plan set up like that, when you look at our 10-year plan, it's basically a mirror. So, and we can go beyond. And when you start to look out 15 years of premium drilling inventory, that's something Crescent Point couldn't have said, when this team took over. So extremely happy with what we've been able to accomplish in the last 5 years. And at the same time, we've got a great corporate culture that we've been able to continue to build from as well. So it's one of those things I'm sure over time you sit back and reflect on and you're probably proud. But in the moment, it's always, what's the next thing?
Hard work.
Yeah.
5 years is not that long.
Well, no, but I'll tell you, sometimes it feels like a lifetime, right? When you step back and think of 2 of those years were basically lost, it's even quicker than that. So, and the other thing I'd say, where we are today as an industry, this industry has never been healthier. Again, you look at this downtown core of Calgary, the whole entire Canadian energy sector, every one of these companies is doing great things. Balance sheets are in pristine shape. They're showing competitive growth. They're returning capital to their shareholders. With where we were 10 years ago as a sector, with where we are today, it's light years ahead. And we, Crescent Point, is just happy to be part of it.
Mm-hmm. To maybe get into the nuts and bolts a little bit.
Sure.
A few questions from the fans on Twitter.
Oh, okay.
Number one, first one that came through is, why did Crescent Point choose to pivot away from Saskatchewan? You touched on it a little bit, and move into North Dakota / the Alberta Montney and Duvernay. Was it an opportunity, greener pastures?
Yeah, I think for us, as we spent time, like I talked to you about our portfolio and what we've been trying to build out on the short cycle and long cycle. We love the Saskatchewan long cycle assets and what they do for balancing our portfolio. I think as we were starting to mature as a company, we recognized that we needed higher, just larger prolific wells, meaning, wells that are coming on at very low capital efficiency, come on at rates of plus 1,000 BOE per day that are, I would argue, are extremely material for the organization of our size. So we quickly understood that in order for us to be a sustainable company for the long term and be competitive, we needed to start to add that type of asset to our portfolio. That being said, we are a liquids company, meaning we produce mainly oil and condensate, and we had that view that we always wanted to stay a liquids company and not really transition to gas. So we had to find assets that fit that profile as well. But for us, it was about long-term sustainability, having assets in play that had significant inventory that allowed us to continue to grow the business. And again, I would describe those assets as being these shorter cycle assets, Montney and Duvernay, being more material, meaning, we can drill 6 wells, bring on 6,000 barrels per day of initial production relative to what we could have drilled in Saskatchewan, where, a lot of those wells are coming on at 150 barrels a day. So, one well that we need to drill here, we'd have to drill 5 to 8 to 10 wells in Saskatchewan to be bringing on those types of rates. It just needed scalability, more material type assets from that type of standpoint. So that's why that transition has happened. That being said, we've got, like I mentioned, we've got about 55 to 60,000-ish BOE per day right now in Saskatchewan. The beautiful thing about Saskatchewan is it's only around about a 15% decline rate. So it takes very low capital to sustain that at a flat level. So if, I mentioned 70% of our capital is being allocated in 2024 to assets that we did not have in our portfolio a couple years ago. So that 25-ish% of our capital for 24 is being allocated to Saskatchewan. The beautiful thing about Saskatchewan is over 50% of our excess cash flow or our free cash flow is generated from that asset. So it gets 25% of the capital, generates 50% of our free cash flow. So you can see on something like that, what it allows you to do for optionality and some flexibility is if you want to redeploy that into the growth of your assets in the Montney or Duvernay, if you want to kick out more returns to your shareholders, if you're going to take a lump of that and pay down some debt, like that asset, the Saskatchewan I've lumped together, both Southeast and Southwest, it allows you It allows you to be a lot more balanced and a lot more flexible with what you want to do with your allocation, just based on the fact that 50% of it comes from though 50% of our excess cash flow comes from that asset and only 25% of our capital spent on it. So, hopefully that answered that person's questions, but it was really, I would describe it as the maturity of a company, right? As you're moving out of what I would describe as moving into larger company assets that we recognize we need to do in order for us to be competitive.
On the subject of wells,
Mm-hmm.
Crescent Point has the best, or if not one of the best oil wells in Canada that you've been drilling in the Montney.
Yeah.
So the question that has come from Twitter, from the fans, what is behind the performance of this well? It can't be repeated.
Yeah. So one of the things that we love about the Alberta Montney acquisition that we picked up, as we really got into that and mined through the data, and keep in mind, we had spent, as you're looking to rebuild a portfolio, you spend a lot of time on certain basins, and we had high graded basins in North America that we were looking at, and the Montney being one of them, and we wanted to stay liquids. So we had a lot of data and spent a lot of time in that phase envelope of the Alberta Montney over the last couple of years. And as we went into this potential acquisition here on the Spartan Delta Alberta Montney asset, that, obviously you go through that process, you get all their data and you can work through it. We love the geology of this play. We love the stacked nature of the reservoir. Our position is in the normal pressured portion of the reservoir. And as you dip to the south and the west, the basin gets deeper and it also gets higher pressured. So you change from a normal pressure regime to a slightly overpressured regime to an extremely overpressured regime. And as you're well aware, pressure is really the reservoir energy that drives ultimately well results. So for us, one thing we did recognize here as we went through this position, and I would give the old Velvet team a lot of kudos as they were onto this kind of near the end. And then really Spartan Delta, I think when you think of that technical team, they really started to pick it up and run with it. And Spartan Delta did a great job in the asset. And at the same time, they did a great job of delineating the asset. So it gave us confidence that it's, north, south, east, west, that they're getting very good well results. But basically what we've noticed in there through the eval was, which tied to our geological model, was that all the really good wells in this particular portion of the play, have been drilled at the base of the Montney C. So if you think of the reservoir, it's stacked from the top, A, B, C, and then D. The really good wells have been drilled at the base of the Montney C, and you use a large enough frac that allows you to split all the way to the top. So you get the C, the B, and the A. The fracs generally propagate to the top. And the reason you can split from the bottom to the top in this portion of the Montney is because, like I was talking about, the pressure gradient, normal pressured reservoir, the pressure gradient does not change between the C, the B, and the A. So there's no real natural frac barriers between those. If you dip into the other components of the basin, they get a slightly different pressure regime in each of those portions, the A, the B, and the C. They've got natural frac barriers in there, so they can't split through that. The good thing for them, those other companies, is it allows you to stack pay or stack inventory within there, right? So you're going to develop the B and you're going to develop the C, and they've got more wells in inventory. For us, we don't have that, because if with a big enough frac, we can split all the way to the top. But, recognizing that and understanding that, we've come in and we're drilling them at the bottom and we're splitting them all the way to the top. And, as this person's question there on that big well, ideally we can have some repeatability around that. And I'm excited to get these results out to the market, because our team has been running with this asset now since mid-May, and things on that front look great. So, ultimately it's understanding the reservoir. We moved in there with a purpose: drill low, split right to the top. It's going to drive repeatability on the well results, and we'll end up seeing how this plays out. But for us, a lot of good work done in front of us between Velvet and Spartan Delta, and we're just going to pick it up and run with it. And ideally, that being said, don't think every well is coming in at 1900 barrel. There'd be a lot of high fives around here if that's the case, but ultimately there is variability in the reservoir, but certainly think there's some repeatability in that.
Buybacks versus dividends.
Oh, yeah.
Do you have a preference, or does it depend?
Okay. So like I mentioned, our return of capital framework is very transparent on how we lay it out to the market. For us, a base level dividend is extremely important to this organization, and we want to grow the base level dividend as we move forward. So our base level dividend is basically set at a simple payout. We pressure test that down to $50, and we don't really like to take that simple payout over a certain level at a $50 price environment, so that if commodities were to ever come off, that the dividend, the base dividend, is sustainable in the long run. So that's how we think through that. Ideally, as our balance sheet gets stronger, as we grow our cash flow and our cash flow per share, ideally you continue to grow that base dividend, and that's extremely important, like I was saying. So then on top of that, this is where our 50% return of discretionary funds flow comes into play. And then the tool of choice that we've been using on that is mainly share repurchases. We favor share repurchases in that aspect. And if you sit back and look at where we are and how we trade, even at a mid-cycle price deck, and I would argue call it $65-ish, our net asset value relative to the level we trade at a mid-cycle price deck, it makes sense for us to be in the market repurchasing our shares right now. And if you want to think of it on a number of different return thresholds, whether it's your F&D or your cycle ratio, for us, when you ground it at a mid-cycle price deck, what's your NAV relative to where you're trading? For us, it absolutely makes sense for us to be in the market repurchasing shares. So we are active on that daily. We bump into the market every day. I would also tell you that you've seen us put out a special dividend here a few quarters. The one thing that's different about our return of capital framework, maybe relative to our peers, is ours is live in the quarter, where some of the peers is a look back. So they look back at Q2 and then they kick that out in Q3. For us, we're live in the quarter. So what that means is our management team has to navigate the volatility in the commodity prices, our production forecasts, our capital spend forecasts, what our cash flows are going to look like at the end of the day, what's your excess cash flow in the quarter. We try to earmark all of that towards share repurchases, but you're never going to get it exact. So at the end of the day, whatever we haven't been able to allocate towards share repurchases, we kick out as a special, is how that formula works. So, this now is our 5th quarter executing against it. We're going to click into our 6th quarter here right away as the calendar turns to October. Very happy with how it's been going, and we are more than happy at these levels to consume ourselves in the form of share repurchases. And especially when you think it, like I mentioned to you earlier, we're 2023, we're going to be a little over 1.1 billion of excess cash flow. 2024's budget is going to be at $80. So if oil stays at $80, we'll be about $1 billion of excess cash flow. So you think of,
that's a lot of money.
Well, and if you think 200 million of that is kicked out in base level dividends, that's $400 million going back to the shareholders in that incremental form of return. And then that'll be, in this instance, again, more than likely share purchases. For us, where we are, hands down, it makes sense.
Reducing the pie.
Right. It's that share count ultimately gets smaller and smaller and smaller, and your value on those shares over time should increase.
Crescent Point is different now. Like we were saying, within 5 years, it's almost totally changed in a way. That's at, I think, roughly, if I'm correct, 0.7 times to cash flow.
Yeah.
Is the goal to go to zero? Is that the idea? Or it's basically at zero now already?
Well, okay. So on the back end of the North Dakota disposition that we just did, the company is going to end the year somewhere around 2.2-ish billion, 2 to 2.2-ish billion of absolute debt. If you talk to the management team and the board, we'd like to drive that down quite a bit more. We'd like to, going forward, I think we'd like to run the business around about $1 billion of absolute debt. So if you think of the company the way it is today, $1 billion of absolute debt would be about 1 times debt to cash flow in that $45 to $50 price environment. And at those levels, I don't want to say you're bulletproof, but you're almost bulletproof, right? When you think of that. That is something that we're pushing towards here in the near term. And I think if we talked about a return framework where we give you 60% of our excess cash flow, keep in mind where 40% of it then comes back to the company. And we are using that right now to continue to strengthen that balance sheet and deleverage. So if the world stays status quo, the company stays status quo, we'd likely beat our debt target over the next, call it 24 to 30 months. So as we really drive that down. And then again, you're virtually bulletproof. And that's just free cash flowing our portion of that down to that balance sheet. So where you'd want it to be. So that's where we're really pushing towards. And we'll see how that ends up playing out. That being said, when you get there, you may make the decision that, you know what, let's strengthen it even further and continue to pay that debt down and see how things play out. But, you know, for us here, the near term goal is to really push towards that absolute debt level, get there over the next, whatever it ends up being, like I say, 24 to 30 months. And then ultimately at that point in time, you've got a lot of flexibility and optionality, what you want to do with that incremental 40% of excess cash. So we'll see how that plays out. But certainly, like we mentioned, feel a lot better about where we are today than we did in May of 2018.
Anti-fragile, resistant to the black swan.
Yeah, and that's the idea. And you know what? Like you and I bet you 5 years ago, we wouldn't have sat around and talked about
stressful.
The bubonic plague coming our way, right? And certainly, you know, if you look back on that and you reflect back on some of the decisions the company made even before that, we made some pretty good moves that allowed us to quickly pay down some debt within the company. And then when the commodities, the bottom fell out like they did during COVID, we were sustainable through that, right? We moved off our Utah asset. We ended up, and we were talking about it actually this morning. It's funny, our infrastructure in Southeast and Southwest Saskatchewan, all those things allowed us to pay down some debt prior to COVID coming our way. And those decisions, thankfully, allowed us to really weather through that. So, but yeah, it's exactly what you're talking about. You never know. And regardless of what industry you're in, and even some of the teams that you've talked to in the past, you know, I know those teams very well and how they think through debt. But no matter what industry you're in, there's a correlation to the best performing companies in those sectors, and they generally have the best balance sheets. Right. And that's generally their management team and their board and the governance around that and how they think through the discipline towards that. So, you know, I think those all tie.
Canadian Energy, the last handful of years, there's been a new crop of CEOs in a way. You, Ian Dundas, Marty Staples, Mike Blinky, kind of some fresh faces. Do you think that new look on things is been coincidence with the reshaping on the industry, or is it's been a kind of bunch of things working together in the sense that the industry's evolved stronger, or have we benefited from a fresh look on things?
You know, that's a good question. So as you mentioned, there's truly new members to this mix here over the last 5-10 years, and I am absolutely one of them, right? I think when you look at the teams across this city, whether they've been in their seats for 2 years, 5 years, 10 years, 15 years, I think one of the beautiful things about this group of people is that they can continue to evolve. And I think a lot of it is, you know, as the market has shifted and changed on energy, and some of it has been positive, some of it has been negative, but as we've all made our way through this journey over the last 5, 10, 15, 20 years, the teams within the sector continue to evolve. And I think what you're seeing right now is really, I don't want to say it's an output of the market's expectations, but it is a bit. You're seeing teams that have, you know, shifted from growth enterprises to, you know, call it more disciplined growth in that, say, 3 to 7% range. They've got more disciplined growth targets. They're focusing on excess cash flow generation. They're focusing on repaying a bunch of that to their shareholders in some way, shape, or form. Their balance sheets are pristine. So, you know, I think a part of that is a push from the market, but I also think a part of it is just us maturing as an industry and understanding what it is that we need to do in order to drive returns for our shareholders, ultimately driving returns from our business, and then pushing maybe a little bit more relevance back into the market as a whole. So like we were talking a little bit at the start, if I sit back and look and we talk about some of the bigger mentors in my career, even just in the last 5 years, never mind the whatever it was before that, but say the last 5 years in this role, the other executive teams, in particular, the other CEOs that are out there that are willing to talk to you and help you along this journey are incredible. And some of these people have been in their role for 2 years. Some of them have been in this role for 15 years. Some of them have made a lifetime out of it. And I've been able to get to know a number of these individuals. And you mentioned a few of their names, and I've got to know them quite well. And if these people are willing to give you the gift of their time, I am more than willing to sit and listen and sop up as much of it as I can. So I think, I guess that's a long way of me saying that, I think you got a pretty good mix in the energy sector of some young blood. I think you've also got a pretty good mix of some wisdom in there that can remind you why it's important to have a pristine balance sheet. Because when you fly a little bit close to the sun, it can be painful. And so I think you got a good mix in this sector as a whole.
Speaking of the benefits of Canadian energy, one of the nice things about industrial development is that, if I'm correct, Crescent Point will spend about $1 billion this year in CapEx, but just to stay flat. How much do you think Crescent Point injects into the Canadian economy without new spending on an annual basis? Maybe you don't have the number off the top of your head, but it's got to be, it's a lot of money.
If you think of our 2024 budget as the calendar's starting to flip into that year, we're going to spend in the neighborhood of $1.05 to $1.15 billion to execute on that in the capital program.
That's new.
Right. And that's new capital going into the market, into the economy. But the other thing you need to keep in mind is we also, spend about $500 or $600 million on operating costs. So that's just on OPEX expenses that you are spending as well to maintain those assets that you're running. And then you have your G&A on top of that. And then you have your royalties on top of that. This word is coming all of our way, and that's taxes. The corporations, I think a lot of them flipped this year, by this year, I mean 2024, they're going to be paying a bit of tax. Crescent Point has a number of tax pools in front of us that we're fairly sheltered from that. But I can tell you, when you look into 2025, if oil's $80, we're going to start to pay about a 4% effective tax rate. And then that moves to around 10% effective tax rate going forward. So you start to think of capital, operating expenses, royalties, G&A and those expenditures, and then you layer on taxes. You can paint yourself a pretty big number for what a company like this puts into the economy alone. I'll even tell you another example. There was an initiative driven by one of the CEOs where their team brought in a number of the summer students at the start of the year and just had an industry welcoming for these summer students, because we want kids and younger professionals to understand how great of a sector this is, that there is the opportunity for extremely long-term jobs within this sector, great paying jobs and that sort of thing. So we had this at the start of the year, and then we did a wrap up at the end of the year, and we did it here at Crescent Point. 13 companies were part of that. And those 13 companies last year alone paid $6 billion in royalties. Like, that's just 13 of us. Never mind
right,
I guess so.
Canadian economy.
Yeah. And that goes right into, and that's where you think of what we do as far as the GDP, and then what that means for hospitals and schools and just the quality of life. It all ties back to why I'm extremely proud to be part of this. It's full of great people. It is full of great people. When you look at our capital allocation framework, we have a commitment to spend around 10% of our capital program to long-term initiatives. So for us, long-term initiatives are water floods, polymer floods, always some stepo drilling, these sorts of things. So then you layer that on. The other thing we've got within our capital allocation framework is a commitment to return or to spend about 3 to 5% of our sustaining capital on environmental initiatives. So for us, the biggest things obviously there are going to be pushing and driving down your overall emissions intensity. The other component of that we spend a significant amount on is our asset retirement obligations. So when we talk $1.05 to $1.15 billion next year, that's fully baked. It's got all those initiatives in there as well. So sustaining capital for us is about $900 million is how to think through that. And then operating costs on top of that is $840 million. So, but that's just us.
One company.
Yeah. Yeah.
Preventing bureaucratic bloat. One thing that happens to companies as they grow, sometimes in the negative sense, is they get bureaucratic and decision making slows down. How does Crescent Point prevent that, and to make sure that you're not hiring drones, so to speak, and you're able to think quick on your feet and keep the organization lean?
Yeah, I think one of the things for us is, that although the company is fairly old, mature, the management team is fairly new, 5 years. So we've been able to make a lot of changes over that 5-year period. And obviously one of the things that we don't want is bureaucracy. We want to be extremely fast and nimble. We spend a lot of time with the organization on empowerment and accountability and making sure that we have proper decisions being made at proper levels so that we are able to be a lot more flexible and agile in that front. So that not every decision needs to be made by me. That's extremely ineffective if that's the case. And then at the same time, we're not doing any of our team or the staff. We're not giving them the opportunity to grow and have those, that decision-making authority. So for us, it's just staying conscious around that. And how do you balance that? What's your decision-making framework around that? And when it's clear and transparent, people know where they can make a call and then move forward. And for us, we try and push that down as far as we can within the organization. The other thing about that too, though, is as the company has changed, we've got a lot less assets in our portfolio than we did in the past. And because of that, you don't need the sheer volume of people within the organization that we needed in, call it 6 or 7 years ago. Just as an example, we drill about 150 wells a year right now. The company used to drill about 500, 550, 600 wells a year. So you think of that machine that's needed to keep that in place, that system and that process in place relative to where we are today. You just don't need that sheer volume. So, that inherently removes a little bit of bureaucracy too.
Perspective of investors, sometimes there's clues. The antithesis of bureaucratic bloat might be Berkshire Hathaway, where there's maybe 20 people at corporate head office in Omaha. Warren Buffett's willing to do Q&A for hours. Maybe one clue might be the CEO sitting down to do a podcast like this. So
yeah,
it's there's correlations.
Yeah, well, hopefully it's right.
Yeah. Quality of knowledge. Some CEOs beat their chest on the way to the top, sharp elbows.
Yeah.
When they get there, the quality of their knowledge isn't sharp. You have built your career on technical knowledge and quality. How do you stress test that to make sure that you're still making technical decisions that are high quality?
So I'm obviously technical background in engineering. I think for me personally, it's been helpful as we made our way through this. I think that especially when you think of what we needed to do in the portfolio, that in mind, the most important part of being a successful CEO is putting the absolute best people you can find and putting them around you. And when I look at our board and our executive team, and I look at the extended leadership group within this company, it's outstanding. So, you have that comfort in the back of your mind that there's people along the way going to do the pressure testing that maybe I would have done in the past. And that gives me a lot of comfort. That being said, you still being technical, you still like to dig into the details and ask some of the questions. But, this younger generation, they're a lot smarter and a lot quicker than I am, and they move fast. So as innovation and technology is changing, they're maybe at more of the forefront of that than I am. So you play a little bit of catch up in those areas. But I think for me, what gives me comfort is fully trusting the people you have around you. And whether it's on the technical side or the financial side, and knowing that these people are absolute experts in their areas, it gives me a lot of comfort moving forward. And I think for me, it also gives me a lot of comfort on confidence in the decisions that we made, knowing that the scenarios we're looking through have been pressure tested in a variety of different ways, not only from the technical standpoint, but also from the financial standpoint. And then how does that come together? So I take a lot of comfort just with the people that surround me, because if you think in this role that you can make every decision and that you have the capacity for that, the company's moving at a snail's pace, right? So, and in this day and age, the world just moves too fast. I mean, everything's on your phone. The market's moving like this. And so with the people that I've got surrounding me, regardless of what level, like I was saying, board, executive team, I take a lot of comfort in having that expertise and knowledge base in those certain disciplines that we need to move forward. But I do like to lean in every now and then on the technical stuff a little bit. So,
do you find yourself in the M&A data room a little too often, maybe?
The one thing with those is as you get into those data rooms and you learn, it's learnings from different companies on what they're doing and the innovation on different teams. So for that, it's certainly a bit of a learning. I obviously never get, me personally, I don't get right in there, but I quiz the teams is where we've been going through things and looking. So, but yeah, that's where you sit back and look at this sector. It's mind blowing, the innovation. And it's like, think of this, like we as a whole, the sector, we'll drill 2.5 miles vertical down. We'll drill a well 2 to 3 miles out lateral length, and you're steering in a zone that's, it can be 5 meters, right? Or 15-ish feet. And you're trying to steer in that. Like and the drilling team is keeping you in zone the entire way, and the geos are steering. And it's, when you sit back and really think of that, and then you have the completions teams coming in behind doing horizontal multi-stage fracs that whole, everything I'm talking about there is really the shale revolution. And it took the US to basically 12 million barrels of oil a day. Mm-hmm. So it's incredible.
Seems like the best management teams balance the technical with capital allocation skills. How did you recognize the importance of that? Where did you learn that? Was it did you always understand that, or is it evolution?
Yeah, I think, again, when you double back and you look at our management team, I would give my CFO some kudos. He's an extremely smart person, and he's helped me a lot through this journey and over the last 5 years. And capital allocation for us coming out of the gate was a major focus on how do we allocate that across the portfolio, but also how do we then allocate that excess cash flow and that return. And then that's where 2 simple slides in our slide deck, and you may, people, I bet you they just gloss over them. The capital allocation framework, that creates discipline, and it creates discipline in the process, and it has you think through your budgeting process. And does your budgeting process tie back to this? And you know what? I can answer yes, as we go back to that every year. And like I was saying, it also drives the long-term initiatives on how we think through that, as well as the environmental initiatives. So not just your sustaining capital, but the business itself has to be healthy and better as a whole. And then when you look at our return framework, again, a simple slide, but it shows them the exact math on how we think through doing it. And I can assure you, when we say we're going to allocate 50% of our discretionary funds flow every quarter, we're hitting 50. And it's transparent. It's basically, like I was saying, a contract with the market on what we're going to do. So capital allocation across the portfolio has changed as we've rebuilt the portfolio. And we try and always make sure of a balance of, okay, what are our corporate targets on a variety of things? Like I was talking, maybe a little bit of production growth. More importantly, excess cash flow per share growth, because that's really what we're driving towards. Production is basically, I would say, the output of that a little bit. But really, okay, and when you look at the portfolio, where do you move your dollars to in order for you to hit that? And I think for us, we've done a pretty good job, especially as the portfolio has been changing. But, when I look at our 5-year plan, like I mentioned, 5% CAGR on production. So our production grows. More importantly, 3% CAGR on our excess cash flow per share, which grows our return. And I would describe that as very disciplined, sustainable, competitive growth. The other thing, if oil is if we put a $75 price deck on our commodity for the long term, at $75 in that environment, like I just mentioned to you, we generate $4.3 billion of after-tax excess cash flow, of which that 60% of that's going back to you. I think the capital allocation process kind of in this instance, it works pretty well.
The numbers speak for themselves nowadays, but some investors are reluctant to come back to the sector. Do you think that the excellent returns is the catalyst, is the cure in a way to the lack of interest in the sector the last few years?
I think it's sustained returns, right? Like it's one thing for us as a whole to be doing this for
a couple of years.
Yeah. Like, even 2-3 quarters.
Exactly.
I think the market really wants to see us delivering this for a pretty good term before they really start to weigh in heavily and come back like the market had been in the past. There is, over the last 10 years, you've lost a number of generalists, you've lost a number of energy specialists. So having that, the firms out there were maybe changing their capital allocation and their portfolios with an eye to energy transition and that sort of thing, and how maybe some of that's played out. But I certainly believe now with the returns, maybe people understanding, or the investment community understanding that, oil and gas is going to be here for a very long time, that it's not a twilight industry, and that the returns out of this sector are as competitive, if not more competitive than anything else out there. I think as you demonstrate that for whatever it ends up being, 24, 36 months, they're going to have no choice over time, right? Because ultimately returns for their investors is what drives their decisions as well too, right? So I truly believe, and I don't know if you felt it out there, but I felt this sentiment change. Now we just need some of this capital to start flowing our way. So, like if you look at mining and gold in particular, they went through a fairly similar phase of maturity of the sector where they grew for growth's sake, and money was being, for lack of better terms, vaporized, and the ultimate return to the shareholders necessarily wasn't there. And that sector has went through this, and I think we're maybe a few years behind that, but certainly you can use that as an analogy to how that's played out. So, yeah. The other thing I tell you too, going back to, and I point to the Calgary downtown, and just, I think the discipline is in the system where we talked about kind of 10 years ago where people were just growing at 10, 15, 20%. Now when people talk growth, it's sustained, it's for the long term, it's somewhere between 3 and 7%, which I would argue is discipline. They talk about returning capital, and really that creates discipline in the whole industry. But the other thing is, it also doesn't create a surplus of supply, which paints you a pretty constructive picture for both commodities in the long run. And that's where all these things start to, maybe it took us 100 years to figure this out, but we certainly seem to have figured it out. That's where that blend of old and new teams helps, right? So you got some wisdom in there of, hey, we've experienced this before, and you've got some of the new teams maybe thinking that this is the way the world works in the first place. So,
King of capital allocation is back. Warren Buffett, he owns Occidental now.
Yeah, he does, and he's slowly was chipping away at. Now he owns quite a big position. I think when you look at Occidental, they've got both obviously the oil and gas production at the same time. They do have that CO2 sequestration, carbon capture, and so that is one of the things that they're looking at as well too. So ideally, it plays out well. But yeah, anything Warren Buffett is doing, I tend to think
that's a good thing.
Yeah, yeah.
The corporate graveyard. Do you look there too to learn lessons from the ones that didn't succeed?
Yeah, it's hindsight's 20/20 as everyone always says, and it's easy to look back on some of those things. I think you can see mistakes that maybe companies have made along the way, and you don't want to replicate those, and you've always got to learn through that, right? I think for us, maybe that's why we're so proud of what we've done, is when you really think of the balance sheet and the portfolio having been rebuilt live, as you look at it over the last 5 years and where we are today. And I'd argue, an extremely competitive company now when you fit us within the sector. So yeah, you always look back on that. You never want to be one of those, but it takes a pretty big balance from the executive teams and the boards to make sure that you're making the right decisions. I also think it takes a little bit of humility on our part to just do better, right? Do better. Ideally, we're never talking about that, but Yeah.
Learn the lessons.
Yes. Yeah. I think we can all learn from the past, right? If you don't, then what are we doing?
As the CEO of a large company, it's easy to go down rabbit holes. What do you find your best use of time is? Is it sharpening your capital allocation skills? Is it leaning into the technical? What's the best use of your time?
When you think through that, we've got a very good process in place now as far as our capital allocation. And a lot of that is driven through the asset teams that flows into our COO, and then it comes up through our CFO and into me. And as we think through balancing that process and having those frameworks in place makes it very easy for the staff to understand on how we're going to do things. So that is there. I think for me, a lot of my time is spent on strategy, is both with the board and the executive team. Where do we want to go? The pace and the cadence of how these things are going to play out. The other part of it is, if you think of your time and your allocation, I've got to give back to the sector. So I do that as well. We are members of CAP. I'm actively part of that, and it's important for us to be part of that. At the same time, even given some of our time into the community, the volunteering and that sort of thing is important. Day-to-day operations. And then when you get time for yourself, you've got to make sure that you're recharging your batteries too personally. So for me, I'm a father of two. I've got two young daughters. I've got an outstanding wife. Those three people in my life can absolutely recharge my batteries. I also like to fly fish quite a bit. So if I can get some time doing that, as far as the business, like I was saying, day-to-day operations strategy, capital allocation, the processes around that, that's all part of your day. But, your comment earlier, and you've got to recognize pretty soon if you're putting your head into a rabbit hole and what exactly you're doing. And is that the best use of your time? And should you maybe pull your head out of there and actually look up before that train coming down the tracks hit you square in the mouth? So it's a bit of a balance, I guess. But you absolutely need to make sure that you recharge.
Your time is valuable.
Yeah. Yeah. And that's the other thing I've learned. As you talk, you even named, like I said, you named some of those CEOs. I can give you a full list. If somebody like that is willing to give me their gift of time, I absolutely appreciate it. And then in turn, I need to be able to give people my time. It's kind of your duty, right? If you want to be a good corporate citizen. So.
Well, maybe to wrap things up, last question.
Sure.
Speaking of mentors and people you listen to and wisdom and all that, sometimes good advice and bad advice is two sides of the same coin. What's the best advice and the worst advice you've ever got?
Yeah, the worst advice I'd have to think back on, but if I think of the best advice, and this is a person that maybe lived a similar life to me, where I took over a company that had some challenges and completely turned that company around. That person simply told me to put my head down and you can do it. And you're going to do it, and you just got to power through it. Things are going to be bumpy and rough, and there's going to be backseat drivers and second guessers along the way. But if you know in your mind that it's the best and right decision, then just continue to move forward. And that I can tell you that takes guts, right? When you're churning your way through things and having sometimes the light at the end of the tunnel looks pretty dim. Over time, it gets brighter. If you just keep moving forward, it does get brighter and it gets better. And so that person had been through this before, and they maybe helped me think my way through that a bit here. Yeah, as for the worst advice, at one point in time, one person told me capital allocation was a fad.
Bad advice.
Yeah. So you take them with a grain of salt, right? But really? Yeah, you look back on some of those. Yeah. Interesting.
Fair enough. Well, I really appreciate your time.
Yeah. No, this was great. And thanks for having me. And, hopefully it leads to a few more questions that come our way, and maybe some of our analyst calls when we have them on the quarter. So thanks for your time.
That's it. We'll stop there. Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.